Good morning, ladies and gentlemen. Welcome to our tax webinar. It's such a pleasure to be hosting you this morning. My name is Caroline. I'm one of the directors here at Nexia SAB&T. I'm delighted to be joining my colleagues from our tax department for a session I believe will be very exciting and informative. But before we get into that, I'd like to get some of the administrative matters out of the way. So our session is scheduled for 1.5 hours. And during this time, all the mics will be on mute. So please, you're welcome to use the chat box to ask any questions or make any comments. We'll attend to those as soon as possible. After our speakers have concluded their presentations, a few questions will be answered during this session. And I must apologize in advance if we do not get to answer all your questions, but we'll share our contact details and you're welcome to contact us directly. Our first speaker of this morning is Bashir Adam. He is the CEO and co-founder of Nexia SAB&T. He has over 30 years of experience in the profession, specializing in tax, corporate finance, audit, and consulting. Our second speaker is Mr. Hassan Kaji, one of our directors in our Cape Town office. He has over 40 years of experience in the industry, and he specializes in tax, entrepreneurial business services, and external audit. Ladies and gentlemen, Bashir Adam.
Thanks, Caroline. Ladies and gentlemen, like Caroline said, welcome very much. Welcome to our presentation, and thank you very much for making the time and effort to join us this morning. If you've been following the news in the last few days, things like NSFAS and budget demands and budget cuts and all of these things are stuff that are beginning to plague the country as a whole. So we're going to all of those things, and we'll focus on two specific areas of the tax proposals going forward. But if I could take you through just a little bit about Nexia SAB&T. We were established in 1994, so about 26 years in business. So it shows that we're not one of those little fly-by-night firms that start off and disappear off the radar. We've got 9 offices throughout South Africa, and we're currently the 8th largest firm in South Africa with over 500 people and 36 directors. We are currently a level 1 BEE status firm. And if you look at the slide, you'll see that all the accolades and accreditations that we've put together, and we really are a firm that provides the full services that you'd expect from a medium to large firm in South Africa. And I think we differentiate ourselves because of our availability to clients as and when they need to speak to us. Just a little bit about our services. Like I said, we offer the full range of services, and I'm not going to go through each of them in detail, but by and large, management consulting and advisory, audit and accounting, tax, the reason you're all here this morning to understand what the tax proposals going forward is and what our budget proposes the year ahead. We have, in the last few years, become very close and intimate to the turnaround and restructuring and insolvency side of the business, as well as the risk management and advisory. And our very newest service line is automation and digitization. That area that ties in with the fourth industrial revolution, where we are getting robots and machines to be more efficient in our business processes and provide efficiency. So if there's anyone that really wants to improve your business processes, please get in touch with us on that. We'd be happy to share some ideas with you. So let's go into the budget and what happened. Now, some of you may have attended our presentation last year that happened just before COVID-19 hit the country and life as we knew it came to a standstill. Now, last year, I made certain predictions in that budget, one of which was that we would continue to have service delivery issues at local government level and indeed throughout the public service. And I think that prediction has come true. We've just, if one looks at the municipalities, many of them are bankrupt and are not going concerns. There are an increasing number of potholes and protests relating to service delivery. So these are the kind of things that we predicted. and it was realized. It actually came through. More bailouts for the state-owned entities. Now, if one looks at SAA, who's still not flying, but we're looking for 10 billion rand in order to conclude the business rescue process and to restructure the business. So we predicted that bailouts will be the order of the day for the state-owned entities because of the inefficiencies and in many cases the mismanagement and state capture that happened with the state-owned entities. So unfortunately, these are predictions that one wouldn't want to see come true, but they did. The falling currency, when we did this talk last year sometime, we were at about 13 Rand. We currently hover around 15 Rand. And while there are proponents that say the Rand is undervalued, there are many that says the Rand is overvalued and we are going to fall further. Many people, in fact, are hedging their bets against the Rand. Junk status, I think that was inevitable. For the last 3 or 4 years, we've been talking about the fact that we will get downgraded. And eventually, when the pandemic hit in March last year, the last of the big ratings agencies, Moody's, just decided that enough was enough, and South Africa was downgraded to junk status. We were fortunate in that we didn't lose as much as we thought we'd lose in terms of foreign funding in the country. Nevertheless, the effects of junk status is going to stay with us for a while, and it is something that we need to get used to. The story about increased debt, and you'll see the picture that says until debt tear us apart. As we go into this year's budget, we'll understand that from a South African perspective, we are growing our state debt to the point where we may get ourselves into a debt trap and end up sitting on the edge of the fiscal cliff where we may not recover from. And the cost of servicing the debt, unlike most people believe, government debt bears interest and government debt has cost. It's not an interest-free debt. And that is something that is really going to take its impact on us and our ability to pull ourselves out of the hole effectively that we've dug for ourselves. And then we predicted that there'd be limited options for Minister Tito Mboweni in terms of what he needs to do, and as the Minister of Finance, what he was going to do to get us out of the hole. And again, that proved true. If one looks at this year's budget, it was nothing spectacular. There was nothing really great that came out of that budget. But really, because the minister has no room to move because of where we find ourselves. Now, ladies and gentlemen, after last year's budget, what happened? COVID-19 happened. The world as we knew it changed. Everything we knew went out of the window. All the money and the economic growth that we thought we'd see in the 2021 year just didn't happen. So what happened with COVID-19? We had a number of lockdowns that impacted the economy completely. In fact, if we think about the very first lockdown at level 5, the South African economy came literally to a standstill. Already with a very high unemployment rate, the COVID-19 pandemic impacted and brought more job losses. Industries like leisure, tourism, the food and beverage industry, etc., etc. So unfortunately, it's one of those things that we've had to live with. As a result of the COVID-19 package, or COVID-19 pandemic, government needed to find the funds to support businesses, to support everybody. And that's where the Uif TERS came in. Now, one now needs to ask the question, how much of that was real, genuine support? And how much of that was actually a front or an excuse for corruption? And we can tell you now, you just follow the news and there are all sorts of allegations that the whole TERS system was mismanaged from the beginning. Government guaranteed a number of loans with or for smaller entities with the financial institutions. And interestingly enough, the take-up of those loans haven't been as envisaged because there are still costs and conditions attached to those loans. So one really needs to ask the question, were those government guaranteed loans really a stimulation package or a support package, or was it just a means to appease the small business entities or the smaller entities to say you could do this? So we faced economic contraction on all sides. We, in terms of personal protection equipment, needed to embark on emergency procurement that had further impacts on the fact that we were already in trouble before the pandemic hit. South Africa was already in trouble before the pandemic hit, so we had no room to breathe. We had no buffer to take us through the pandemic. Of course, the pressure on the health system, we all know that with the second wave, there were no beds available. ICU beds came at a premium. And in many instances, those that couldn't afford private healthcare had to suffer in a public healthcare system that was already under significant pressure. And then last, ladies and gentlemen, is corruption. One needs to ask the question, with everything that happened in COVID-19, the one ugly thing that still came up was corruption. There were tender processes that were being sidestepped. There's significant allegations of people who enriched themselves through the emergency procurement processes, etc., etc. Now that begs the question: was COVID pandemic just the ideal scapegoat for government, the opportunity for government to say everything happened because of the pandemic, rather than admitting that we were in trouble long before the pandemic happened? So that's the story of COVID-19, and the reality about it is that it's going to stay with us for a while. It's not going anywhere in a hurry. That was me. All right, and then in the run-up to the 2021 budget, we made more predictions, and we speculated on more things. And some of the stuff that we speculated on was that there'd be growing government debt and an interest burden in a bid to plug the holes. And the reality is we have holes. There were all sorts of speculation that we'd be plugging the gap directly with increased taxes on high net worth individuals. As we'll see later in the presentation, that didn't happen. There was the floating around of a number of 40 billion rand that everyone thought government would try and raise from high net worth individuals. There was talk about a solidarity levy, basically a levy levied on all taxpayers, particularly those in the upper brackets, in terms of funding some of the gaps within the South African budget deficits that was just growing. That's all it did, was grow. There was speculation that all capital gains tax would be taxed, and that would remove the inclusion rate. Now, that is not too uncommon around the world, but certainly it was something that we thought will happen in South Africa this year, and it didn't happen. And then indirectly, increasing sin taxes, alcohol and tobacco. You know, it's something I think about, and I think it's about the pleasure is what we pay for alcohol and tobacco. Increasing the fuel levies, and I'll talk a little bit about increasing the fuel levies later, because I have a fundamental problem with the fact that we increase a significant part of the fuel levies go to the RAF, which is an organization that is bankrupt and has been bankrupt and insolvent for the last 20 years to the tune of over 20 billion rand. And the increase in sugar taxes, that so we speculated that there will be a significant increase in sugar taxes on carbonated drinks, etc., etc. And part of that did come through, but not to the extent that we expected it to be. So if we look at the 2021 budget, what actually happened there from a South African perspective? The budget deficit was revised from 14% to 14% from 6.3% as it was pre-COVID. And here is a typical example of where we see the economic pressures of COVID-19 being stated as the reason and the only reason for the budget deficit being revised. Now one needs to ask the question, is it really the only reason that deficit needed to be revised? Our gross debt has increased from 65%, which is kind of acceptable in emerging economies, until up to 80.3% for the year 2021. Now, when we look at 80% of GDP being funded by government debt, then we're getting very close to the debt trap and the fiscal cliff, where there may not be a way out if we continue down that path. The 2021 budget proposes to narrow the budget deficit from 7.5% going forward to 0.08% or 0.8% in 2023-2024. Again, the jury is out. Is that going to happen? Who knows? And then the shocker, we're already on 80%. We're going to go to 89% in 2025 and 2026. Now, ladies and gentlemen, the fundamental of that is that we end up paying to service that debt. And as we go through this presentation, there's a number of statistics that I'll share with you that actually shows what the implication of that is with us. Government will roll out a free mass COVID vaccination campaign, of which 9 billion has already been set aside for. Now, if one again thinks about it, other than the rollout for health workers, we haven't started the rollout in South Africa yet. In fact, one of the Sunday papers reported that the health regulator is still testing the Johnson & Johnson and Pfizer vaccines in South Africa. So if they're still testing those vaccines, it's anyone's guess as to when the mass rollout is actually going to begin. And then finally, over the medium term, the debt service costs are expected to average at 21% of gross revenue. Now, what that means for us as the taxpayer, for you as the taxpayer, is that for every rand of tax that you pay, 21 cents is going to go to servicing the debt. Now, when we look at that, that's 21 cents that could be spent on poverty alleviation, on community services, on social development, and on education, etc., etc. Instead, what are we doing? We are funding the debt through our taxes. Right, so let's just unpack the budget a little bit. If one looks at it, and if you can see my mouse on it, we, in the medium term, are budgeting for revenue of 1.5 trillion rand to come into the coffers. Now, again, one needs to ask the question, when we budget revenue to go up from 1.3 trillion to 1.5 trillion, it assumes economic growth. It assumes companies are going to recover. It assumes unemployment will come down. It assumes that entrepreneurship will take its grasp. One needs to ask the question, are we really in a position where we can do that? Are we going to collect that money? If one looks at the current year, we were going to fall short. We were only going to collect 1.1 trillion, and through a windfall and the commodity prices in going up in the last quarter or the second last quarter, that number up to 1.3 trillion rand. Now, 1.5 from 1.3, ladies and gentlemen, in my opinion, that's a tough ask going forward. From an expenditure perspective, we budget expenditure of 20 or just over 2 trillion rand. Now, one needs to ask the question again, when you have X amount of revenue and you have Y amount of expenditure, in order to narrow a budget deficit, the revenue needs to exceed the expenditure. Now, typical of governments and states around the world, we are budgeting for a budget shortfall of 500 billion rand. Now, where do we get that 500 billion rand? If the taxpayers are not paying it, we've got to borrow it from somewhere. We've got to get it from somewhere in order to fund the expenditure. Now, interestingly enough, and I'll talk about it later, one of the biggest ticket item in the expenditure is government salaries, the government wage bill. Indeed, we are one of very few countries in the world where it appears that the salaries in the state and the government sector almost exceed in many sectors the salaries paid by the private sector. It's mind-boggling when one thinks about how that's grown over the last 20 years or so. To unpack that budget further, so where are we spending the 2 trillion rand on? And if we look at it on learning and culture, 387 billion. Ladies and gentlemen, if we don't get the education right for the future generations, then our problems won't go away. They will just keep on compounding and compounding and compounding. The health system gets 247 billion rand. And one needs to ask the question, if we look at the problems that we've had with the health system and the pressure on the health system during, particularly the public health system during the pandemic, does that work for us? Is it enough? Social development will get, I apologize, I'm on the second column. Social development will get 335 billion. Now, we asked the question from there, and I know it is something that everybody asks. We pay 18 million grants in a month. Now, as we go through the presentation, I will show you that we have roughly 7 million taxpayers. Now, when 7 million taxpayers pay the tax to fund a population of 60 million, something's got to give at some point. Somewhere it's got to crack, and we need to look at that. Community development is 218. Economic development is 207 billion. And if we look at community development and economic development, those two have the biggest growth over the next 3 years. And maybe certainly economic development needs the biggest growth because we need economic stimulation. But again, on the next slide, I'll point out to you that that economic stimulation may not be in the way we expect it to be. And there's all the other items. Peace and security goes down in terms of its budget by 10 billion rand. When one thinks about that, you think about the fact that our crime stats in real terms don't seem to be coming down, yet we're dropping the budget on peace and security. General public services, 68 billion rand. And then the interesting number is at the bottom, the debt service costs. Again, that's what we're spending to service the debt. It just makes no sense at this stage. If we look at that number is the third highest number in the budget behind education and behind community development. We spend 270 billion rand just on funding our debt on an annual basis. Ladies and gentlemen, on the right-hand side, you see the little diagram. All it is the debt trap, and that's exactly what seems to be happening. We spend more than we earn. That's the budget deficit I spoke about. We borrow to fill the gap. More of our income goes to repay the debts and the debt costs. What happens? We need to borrow more to fund the expenditure, and the end result is we have nothing left. And what's the real situation when we have nothing left? We start defaulting on debt, and our debt service cost goes up, and everything spirals out of control. So where are we spending our money? If we just unpack the budget, I'm not going to go through all of the line items in detail, but there are some that I'd like to point out. So we did say the lion's share goes to learning and culture. And the interesting point is the National Student Financial Aid Scheme. Now, if anybody listened to the news yesterday, Minister Bladen Nzimande is quite adamant that government needs to spend more and provide students with more tools and equipment, and asking for an additional 9 billion to be able to do that. Now, ladies and gentlemen, if you follow the history of the National Student Financial Aid Scheme, it has been plagued by corruption over the last few years. And what are we doing? We'll give them another 37.3 billion rand and let's see how much of that finds its way back to the students, really increasing education, and how much of that will be subject and unfortunately be prone to corruption going forward. The health services, as I've previously said, 248 billion. It's less than what I would have expected given the pressure on the health systems in terms of where we are. Some of the largest regional hospitals, those that come to mind are Chris Hani, Baragwana, Steve Biko in Pretoria. Those are all hospitals that are critical to our public health system. And those hospitals are underfunded, significantly underfunded. And all you need to do is spend some Sunday evenings watching Carte Blanche to get the real picture of where we are on those things. And then social security, the second largest item in terms of the budget. But if we look at it, it's the number of grants that's there. Now, ladies and gentlemen, one needs to look at that in the context of the history of South Africa and the amount of grants and people that were previously excluded from the economy. So do we have a responsibility? Yes, I think we do have a responsibility. Should that responsibility lie on a handful of people? Probably not. But it is something that we need it is something that we need to be aware of going forward in order to avoid ourselves getting into a hole that we can't get out of. Some of the other big ticket items, economic development, as I said, is one of the biggest growth items going forward. One of the things that worry me a little bit about this one is economic regulation and infrastructure. Now, if you follow the economists and many of their prediction, then one of the reasons that we are being held back as an economy is that we over-regulated in so many ways. It's difficult to do business in South Africa. It's difficult to register businesses. It's difficult to get the VAT numbers. It's difficult to register and have a seamless business operation or a simple business operation. And that's one of the things that really concern me, is the fact that we continue to regulate and regulate. And my theory around that is the regulators in many instances are people that are not experienced in the industry in which they're regulating. And what they do is they increase the red tape that is there and makes it more difficult for those entrepreneurs and those business people who can create business, who can create business, who can create employment, who can stimulate the economy going forward. Again, we come back to 269 billion, the debt service costs that we have. And then we have a contingency reserve of 12 billion. Now, ladies and gentlemen, ask yourself the question. We couldn't find as a government, not as private sector, as a government, we couldn't find 270 million rand, not dollars, 270 million rand to pay the deposit for the vaccinations with the COVAX scheme. Now, if we couldn't find 270 million rand to do that, where do we get a 12 billion rand contingency reserve from? So one needs to look at the budget with, I think, with being realistic about it, not necessarily being pessimistic, but being realistic about what can be achieved and what can't be achieved. And I'll unpack some of the other proposals as we go forward. So we've now spoken about the spending, and we're going to spend $2 trillion, 2 trillion rand. Where are we going to get to? The first place we've got to look is tax. That's where we've got to look from. And so government and Minister Tito Mboweni came out and said, these are the tax proposals. To stimulate and support economic recovery, we're not raising the taxes this year. So for the first time in many, many years, the net effect of the tax brackets and moving the tax brackets is that taxpayers will pay slightly less income tax going forward. Now, what's the impact of that? And I always say it, the government will never give you what they can't take back somewhere else. So it is impossible that we ultimately have a reduced revenue line. So what's some of the ways that government is going to increase their revenue? The increase on excise duties on the alcohol and tobacco, so the sin taxes will increase by more than inflation at 8% going forward. Inflation-related increases of 15 cents a litre and 11 cents a litre on the general fuel levy. That's 26 cents a litre, of which 11 cents is going to the road accident fund. The road accident fund, which is 24 billion rand in the red, which has been there for the last, which has been bankrupt for the last 20 years, but we just continue funding it. Now, there are so many different models to replace the road accident fund, and government just needs to research it and make it work. But it just seems that we're throwing money down a black hole on an ongoing basis. The Uif contribution ceiling was last revised about 4 years ago, so that'll go up to 17,700 rand. Most of that will be used to replenish the reserves of the Uif that was spent on the TERS support packages that came about because of the pandemic. So if we unpack all of that, the personal income tax bill is going to be 516 billion. We collect 516 billion from the taxpayers in South Africa. Remember what I said earlier? We've roughly 7 million taxpayers in South Africa. So they're going to give us the largest share of the revenue that we're going to bring in is from the taxpayers. VAT will bring in about 370 billion rand. Corporate income tax, 213 billion. Now, if one thinks about the very huge companies and the corporations, the impact of the pandemic and the economic contraction on them have been so large that one would expect that number and the corporates to contribute more than the individuals. It's not. It hasn't been like that in South Africa for 20 years, and it's not likely to be like that going forward for at least the foreseeable future. Fuel levies bring in 83.1 billion. We know we have to pay the fuel levies. It needs to be there. And then there's other stuff, and that's royalties on mines, etc., that bring in 82.2 billion into the coffers. And that, ladies and gentlemen, gives us 1.5 trillion rand against an expenditure budget of 2 trillion. So how do we fund the gap? Right? We fund the gap with debt. What we use is debt, and we borrow the money. Now, if we look again at our gross debt, the gross debt has gone up to 3.9 billion from last year, where we were sitting at about 3.4 billion. And it just keeps climbing and climbing and climbing. And although the minister in his budget speech does say we're going to consolidate at some point, one has to think, if we keep on climbing, when are we going to consolidate? Because it is very difficult at any level, from a personal household to a corporation to a government. It is very difficult to reverse a trend once you've become used to that trend. It's almost like trying to reverse somebody's. It's almost like trying to reverse somebody's lifestyle. Once you've become used to a lifestyle, it's difficult to revise it. And again, if we look at the debt service cost, it keeps on climbing and climbing, which means more than anything, we spend more on servicing the debt that we incur on an annual basis. So, ladies and gentlemen, we spoke about this tax and 1.5 billion, and if you look at it, that's or the 500 billion. That's the 500 billion that we're going to bring in. We go back. There's the 516 billion, and if we look at this table, there's the 516 billion. So how do we fund it? These are the number of taxpayers that fund the tax bill. If we look at the number from there, where my mouse is now, and we go all the way down, that is about 3.3 billion, more or less 3.3 million people. 3.3 million people out of a population of about 60 million is roughly 5.5% of the country. Now, ladies and gentlemen, 3.3 billion people fund the majority of the taxes, then one needs to question the sustainability of how long it will last. Now, in a recent webinar, one of the chief economists of econometrics and probably one of the leading economists in South Africa, Dr. Azar Jamin, estimated that 5.8% of the South African population pay 92% of the total personal income tax. So ladies and gentlemen, those numbers in red are not typos, they're real. And if we go and add it up, there's the numbers straight from the National Treasury budget review that prove that those numbers are correct. And it is estimated that that same 5.8% will pay an estimated 85% of the total VAT bill. So if we look at it from that perspective, one needs to ask the question, what happens to this 5%? What happens if this 5.8% so-called medium to upper class taxpayers were to be not eradicated, but if that tax base were to be eroded even further, how then would we fund everything? So that's one of the problems that we need to look at. Some of the income tax relief proposals, I've spoken up there about the personal income tax brackets and rebates that will increase above inflation, and that will give the personal income taxes some sort of relief. There's 13.4 billion rand of relief which goes to the taxpayers this year. But again, like I said, relief in personal income tax, we increase the sin taxes. So somewhere along the line, it comes back into government coffers. So some of the budget highlights or lowlights, whichever one you choose to use and which is more applicable to you. And if you look at our little icon at the bottom of the slides, it all says it is. And it is whatever you want it to be at the end of the day. It is the way it applies to you. It is what it is. So some of those lowlights is there was a 40 billion anticipated tax increases that didn't apply. So that was a big plus. The high net worth individuals were not hit with additional taxes like everyone thought it would be, because there's a certain sector that believes that if we push the taxes up any more in South Africa, it's going to start becoming counterproductive as opposed to being productive. I've already spoken about the 13.4 billion in tax relief through the increase of the brackets and the rebates. We've increased the medical aid tax credit. So feather in your cap, anywhere between, depending on the number of dependents you have, the medical tax credits increase between 9 and 13 rand per month. So while we push up the SIM taxes and we push up the fuel levies, we'll give you back between 9 and 13 rand a month, depending on the number of dependents on your medical tax credits. There's been a COVID provisional tax relief where 35% of your second tax payment for 2021, the one that should have been paid, if you haven't paid it yet, at the end of February, can be deferred to September 2021 on the basis that you comply with certain conditions, one of the most important being that you're tax compliant at the time. The fuel levy we've already spoken about, and like I said, 27 cents a liter is what the increase is. And if you go and look at the total, currently over 6 rand per liter of fuel that we put in our cars goes to government in some form or the other. So over 6 rand of every liter of fuel that you consume goes to government. And again, the RAF is one that bothers me significantly because there's no signs of a turnaround. It just keeps on going deeper and deeper into debt. Sin taxes I've already spoken about. Alcohol and tobacco to increase by 8%, which is above inflation of 4%. They have included for the first time the heated tobacco products, and they are investigating the electronic vapes, etc., the electronic nicotine dispensing devices, which will be taxed in future. The environmental taxes, the plastic bag levy. Now, I've always referred to the plastic tax levy, the plastic bag levy, as the levy and the legacy of one minister, Vali Musa, who was the Minister of Trade and Industry many years ago. Now, currently, the plastic tax levy is about 25 cents per bag. But when we start introducing bio-based bags, so biological friendly bags, they intend to reduce it to 12.5%. It is not effective yet, but it is due to be effective as soon as they work out the mechanics on it. I've already spoken about the unemployment insurance fund. Now, ladies and gentlemen, the next one that's important is in the budget, Minister Tijino Mboweni says that the state's wage bill will be cut through the limitation of increases over the next 3 years, limiting increases in government salaries to 2.1% for the coming year, 0.9% for the year thereafter, and 0.5% for the third year thereafter. Now, ladies and gentlemen, you can decide and you can form your own opinion, but we have a country and we have an economy where the unions are significantly strong, where the public sector depends on, or many of the public sector belong to unions. Is this going to be achievable? And you can form your own opinion on it. But my opinion is that this is not going to be as achievable as we think it is. It's not easy, but for a minister to make the call that this is going to happen, the practical implementation and the political side of this needs to be taken into account. And one needs to ask the question, can it be done? My view is it's going to cause significant issues going forward. Now, another stat that's important about that is South Africa's state wage bill as a percentage of its total budget is the third highest in the world. The only two that are higher than the South African wage bill as a percentage of its budget is Denmark and Norway. And if you do a little bit of research, you'll find that in Denmark and Norway, the benefits that taxpayers get from the money that they pay is significantly more, probably a few 100% more than what we get in South Africa as far as our taxes go in terms of public benefits. So I think that's something that we need to ponder about. Social grants have been increased by 1.6% to about 30 Rand a month. That's way below inflation. And again, we've got to look at the history of South Africa and the need for social grants. Venture capital tax incentives have been discontinued after 30th of June 2021. Government cites the reasons that the venture capital tax incentive has not had the impact on employment that they thought it would be. It would have. So one needs to take that into account. The jury is out on whether it's a good move or a bad move. Personally, we need people that are prepared to invest in startups and venture capital companies to create employment and economic stimulation. With the advent of COVID-19 and the move for people to work from home, government realizes that they need to look at the travel allowances and home office expenses, and they have undertaken to review that going forward to see how best that could be done on an equitable basis. And then, of course, like we have every year, we increase the anti-avoidance rules, and they're talking about improving compliance. And government has already established a dedicated unit to investigate the following: individuals with complex tax arrangements and the abuse of transfer pricing and tax base erosion. Now, ladies and gentlemen, before I move off to the next slide, I really just want to say, I want to take you back to the number 5.8%. And 5.8% of the population that funds 92% of the tax, the personal income tax, and 85% of the VAT. Now, if one looks at that dedicated unit to investigate, guess who the first people are that's going to be investigated? The same 5.8% that currently pay 92% of the taxes in the country are going to be the first people that are going to be the targets of that, because those are the individuals with complex tax arrangements. Those are the individuals that have interests in businesses that do cross-border business, etc. So that's going to be very, very interesting. And it'll be more interesting to see how that has an effect on eroding the tax base, because probably half of the 5.8% that we speak about of the taxpayer base are people that are likely to immigrate, are people that are likely to have offshore tax arrangements, that are likely to have the necessary means to move their tax residents from South Africa. And that just creates a further problem. The 5.8% becomes less. And then what happens? Ladies and gentlemen, there's two sections that we're going to focus on for the next few minutes, and Hassan Kaji will take us through it. It's the anti-avoidance rules in respect of trusts that were further extended this year, and the proposal by government to reduce the corporate tax rate by 1% from April 2022. So without much further ado, thank you for listening to me. And Hassan Kaji, over to you.
Thank you, Bashir. Very comprehensive insight. I didn't realize, besides being such a very good accountant, I didn't realize you're such a very good economist as well. Yeah, so as Bashir mentioned, I'm going to take you through the two sections. Section 7C, which has been highlighted in this year's budget as well, and also the issue of the decreasing of the corporate tax rate. Moving on to Section 7C, let's just give you some background of how the Section 7C came into being and came into effect from the 1st of March 2017. Prior to the effective date, I think a lot of people, they were structuring their affairs in such a way that it had the effect of reducing the taxes, but more importantly, it had the effect of reducing the estate duty on death. In other words, they were able to peg the value of the assets. So on death, the estate duty payable would have been managed a bit better by moving the assets into a trust. So if you take, for example, a situation where you have, let's say, a block of flats which you buy for 10 million. If you buy that block of flats in your own name, that block of flats, or the asset, the value of that asset on death, would be part of your estate. Now, imagine, you know, after quite a few years after you acquire the block of flats, and on death, the asset, the block of flats has increased in value to, let's say, 15, 20 million, hopefully. On death, that value, the market value, would be part of your estate. So what was the common trend was that people were putting their assets in a trust in order to peg the growth of the assets. So what they do, instead of buying the block of flats in their own name, they would buy the block of flats in the name of a trust. And more often, the taxpayer and his family are the beneficiaries in the trust. The taxpayer would then lend the 10 million to the trust. Also, the 10 million would in most cases be interest-free. So on death, let's say on death, the asset is now worth 15 million. Because the asset is not owned by the taxpayer, the 15 million would not be part of the estate because it belongs to the trust. But the 10 million that the taxpayer borrowed to the trust initially when the trust acquired the asset, that would be the asset in the name of the taxpayer. So on death, what would be part of the estate of the taxpayer would be the 10 million loan and not the 15 million value of the asset, because the asset is in the name of the trust and is not part of the estate. So in order, but you must also remember that the use of trusts up to that point of time, the other benefits of using it, of putting assets in the trust was not only for estate duty purposes. In some cases, there could be tax savings because whatever profit the trust makes, the profit can be distributed to the beneficiaries, provided the beneficiaries are above the age of 18. In other words, the children must be above the age of 18. So you could have distributed the profits of the trust to more than one person and then effectively reduce the tax rate. But a very important reason for setting up a trust, and I think this is something to note, which is not really a tax reason, but the reason is to protect your assets from third parties, okay? A lot of people in business, they stand a risk of losing their assets when they go into business. Quite often, even if they got a business in a company or a close corporation, when they go to the bank for credit, the bank would insist that they sign personal surety. And I know a lot of clients of mine that have signed personal surety many, many years ago. In fact, I know clients that don't even know what personal surety they've signed. So although they are running their business in a company, when the company goes into liquidation, all of a sudden they get a knock on the door and say, listen, you signed surety for this debt or this overdraft 20 years ago. The company went into liquidation. We want the money from you. If the assets are in the trust, obviously they cannot touch those assets. So a very important reason for setting up a trust in, and it's still, despite all the anti-avoidance measures government has put into place, I still feel there are good reasons for using a trust, especially when it comes to asset protection or protection of the assets. So how do we deal with the fact that a person can acquire an asset in the trust and the asset value appreciates over years, and at the death of the taxpayer, there is no estate duty payable on that particular asset except for the loan that was given to the trust? How do we deal with that? So in 2016, government introduced Section 7C, which came into effect on the 1st of March. And the mechanics of Section C is the loans that are granted by a taxpayer or a natural person to a trust where the person is connected to the trust. So let's just take, for example, you, the founder of the trust, and you and your wife and your children are the beneficiaries in the trust. So obviously, you, the natural person, you are connected to the trust. Interest-free loans or loans at a lower than the official rate of interest would be subject to Section 7C. So if you're giving an interest-free loan, that would be subject to Section 7C. If you're giving a low interest loan, for example, you charge the trust 3%, the official rate was about 7.5% for a very long time, especially when this section was introduced. The official rate now, I think it's now came down because of the repo rate coming down. The official rate now is 4.5%. So what Section 7C now says that the interest-free loan or the part of the interest, the difference between the official rate and charging, that would be deemed to be a donation. Now, you know, when Section 7C was considered initially, it was mooted that this interest-free loan or the interest on this loan would be taxed at normal rates. Now, you can imagine all the wealthy people that has their assets in trust and they are taxed at 45%. You can imagine what this would have done to them. So government has come to a compromise, and the compromise was that we will not tax it at normal tax rate, but we will tax it as a donation. We'll deem the interest to be a donation, and donation tax currently is 20%. So the interest-free portion to the trust would be a donation at 20%. Obviously, the donation exemption of 100,000 Rand will apply. So, Bashir, if you go to the next slide, I got an example of how this Section C will work. So let's assume we're going to loan an interest-free loan of 10 million to the trust. And I just use the official interest rate of 7%, although it has come down now. So the interest foregone on this 10 million is 700,000 rand. You are entitled to the 100,000 rand donation exemption. So that will come off the 700,000 rand, and the amount of 600,000 will be taxed at 20%, which will give you 120,000 rand. Now remember, this 100,000 exemption can only be used if you haven't given donations in the past in that particular year. You can't give your children a donation or your niece or nephew a donation and they still deduct 100,000. So what happened after that? So now when the legal eagles and the tax lawyers and the tax specialists realized that now we can't give a loan to the trust, they thought of other ideas. And the other idea was, okay, fine, we will not give a loan directly to the trust. We will give it to the company that we set up, and the company will then give the loan to the trust. Or typically how it's done, a company is formed, and the sole shareholder of the company would be the trust. And because the loan is not from a natural person, it should not be subject to Section 7C. Within a few weeks after Section 7C was introduced, and when government got wind of this way of circumventing Section 7C, they closed this loophole, and the loophole they closed by introducing an amendment to the Section 7C where loans from companies will also be subject to Section 7C. Which means a company grants a loan to a trust at the instant of a natural person, or a loan to a company whose shares are held by the trust. But this is only in the case where the shareholding is more than 20%. So if you got a loan to a trust, or if the company has only got a 5% interest if the shareholder only has a 5% in the company, then obviously this will not apply. So it only applies where the shares are more than 20% held by the company. Next slide, Bashir. So that is how they closed that loophole where the loans were given to the trust by a company. So then, once again, the legal experts and the tax experts, they start scratching their heads again, and they thought of another way of overcoming this. So they thought about, okay, fine. Instead of saying that the company is giving a loan to the trust, we will say that we will convert this loan to preference shares. So in other words, we set up the company, and the trust owns preference shares in that company. And the argument is that preference shares is not a loan. So that's how the loophole was tried to be effected here by converting the loans into preference shares. So in last year's budget proposals, this loophole was closed, and it's now deemed that preference shares is also a loan. So where you convert the loan in the company from a loan to preference shares, those preference shares would be deemed a loan, and the dividends received on these preference shares would be deemed to be interest. It will not be deemed to be, it's not a dividend, okay? So the interest would be taxed as a donation subject to 20%. And this will be in respect of all assessments commencing on after 1st of January 2021. Now remember, this was a proposal last year, and I think just before the end of the year, the president signed off these amendments. So this is effective 1st of January. So now it looks as though that all the loopholes are now closed, and now the tax experts are looking in other ways, and what they are doing now, they are transferring loans between trusts. So where you have a situation where the founder of one trust is related to one or more beneficiaries of another trust. Okay, obviously this is not a loan from a company, it's not preference shares. So government is now looking at coming up with further amendments to Section 7C, where these counter schemes are going to be closed off, and you'll find that loans between trusts would also fall under Section 7C. Okay, Bashir, if you can move on to the next slide, which deals with the reduction of the corporate tax rate. Now, you heard Bashir mention earlier, and because coming out from the budget presented in Parliament 2 weeks ago, that the corporate tax rate will be decreased from 28% to 27% in 2022. Now, this is for years of assessment commencing on or after the 1st of April 22. So effectively, it falls in the 2023 tax year. For many companies, many of our clients, they have Feb year-end companies. So their financial year starts on the 1st of March. So because this is effective 1st of April, they got to wait another year before they can get this reduction of 28% to 27%. So it will be March 2023 for them, because March 2022 would be before the effective date of April 2022. So March 2023 up to Feb 2024, those companies will only get the benefit of the decrease in the tax rate in the 2024 tax year. And I was just thinking about this thing last night. Maybe it's a good idea to think about changing your year end, and you got to do it soon, so that your new tax year starts anytime after April 2022. I'm not sure whether government will look at this as an anti-avoidance scheme and attack it, because the motive or the objective of changing your year end is to reduce tax, but maybe that could be a tax planning tool whereby we can consider changing our year end. And I think maybe if you do that, you must have good reasons to do it and not make tax to be the reason. You know, for example, maybe it's a change of the year end is better for your type of business. February is not a good time to have a year end, but let's not make it to be tax to be the reason. Well, as I said, we don't know whether SARS will attack it or not. When the minister announced the reduction of 28 to 27%, although he did make mention of the two issues that I'm going to talk about lower down in the slide, I don't think he focused a lot on that. And I don't think many people caught on that coming with the reduction of the corporate tax rate is something is going to come with it. I think everybody felt, oh, wow, this is something good news, 28% to 27%. But what he also alluded to something in last year's budget, where it was proposed last year that assessed losses would be limited, and also there will be a limitation of interest deduction going forward. Now, these two proposals were supposed to be effective, I think, January this year, January 2022, January 2022. But I think this is going to be deferred to be in line with the reduction of the decrease in the corporate tax rate. So these two measures are, one, first of all, there will be a reduction, a limitation of the assessed loss. So if you've got a company, let's say you've got an assessed loss of 2 million, and in the particular tax year, you make a profit of $1 million, you cannot use that 2 million assessed loss to knock off against your tax income of $1 million. It can only be used to knock off 80% of the taxable income. So the R1 million, the 20% will still be subject to income tax, and the 80% you can use the assessed loss, and the balance of the assessed loss can be carried forward to the next year. So in other words, you can only use the assessed loss to the extent of 80% of taxable income. The other thing that government wants to do to neutralize the effect of the lower of tax rate is to limit the deduction of interest for business purposes. The proposal is to limit the net interest deduction to 30% of adjusted taxable income. And I think this is mainly for the multinationals that are charging excessive interest rates. Number one, to get the money out of the country, and also to make the company in South Africa pay less tax. They charge exorbitant interest rates, and also in group structures, even within South Africa, where one company will charge excessive interest rates because maybe one company has an assessed loss and they can afford to receive a high interest, whereas the company making the profit, they'll have a higher than normal interest rate. So government is looking at proposals now to limit the interest, the interest deduction to 30% of the adjustable taxable income. That is all from my side. That was that I had to talk about. I'm going to hand over back to our moderator, Caroline, and I'm not sure how we're going to deal with questions, maybe questions on the chat, but myself and Bashir are available for a few more minutes. I think we got until 11:30. So I thank you for listening to me and my colleague.
Thank you, Mr. Kaji. I think now, as stated at the beginning, we will look at a few questions, if there are any, that our presenters can address.
All right, I can see the question, and the question is the interest, or I think it's more a statement than a question, is the interest deduction of 30% on the multinationals will be subject to transfer pricing reviews. Now, transfer pricing reviews are certainly muted to be something that is on SARS's radar and will be subject to further scrutiny, or transfers between multinational companies will be subject to future scrutiny from SARS going forward. So the statement I agree with 100%, and I think they'll look at the interest deduction of 30% to see how that complies with the transfer pricing within that particular group and the transfer pricing documentation, etc.
Thank you, Bashir, for that. I can only see that statement in our chat box. So I think your presentation with Mr. Kaji was very clear. There doesn't seem to be any questions. So if there are any questions coming from our guests, I'd like to thank the speakers, Bashir, Adam, and Mr. Kaji, for such an informative session and sharing your insights. And then I'd like to thank all our guests for tuning in. We hope that you found the session as informative as we did, and that it will contribute positively towards your business and to yourselves in your personal capacity. We look forward to hosting you next time. Please do look out for our follow-up email, which our team will send to you. That will include our contact details. You're welcome to contact us if you have any issues that you'd like to discuss with us. And also if there's any way that we can help you to craft solutions for yourselves and your businesses. Thank you very much for coming, and see you next time. Till then, please keep safe and stay well. Thank you.